Good afternoon, everyone. Thank you so much for joining this important webinar. I'm Morris Tomaselli. I'm the CEO of Strategic Inspections. I'm also the president of Project Review at Condo Tech, one of the nation's leading condominium and cooperative project approval organizations. In my role at Strategic Inspections, our organization essentially does most of the reserve study reports in the New York City marketplace, as well as hundreds of condominium and cooperative reserve study reports across the country. And we thought it was really important to provide you with a little bit of guidance on Fannie Mae and Freddie Mac's new lending policies that were recently released. So as those guidelines relate to reserve studies and the reporting that currently goes on in the industry on components and the financial health of a condominium or cooperative development, we thought it was really important to share some of the trends that were happening in the industry and some of the tips and tricks in order to continue to get lenders to provide residential mortgage financing within condo and co-op properties. We're going to go over a whole bunch of stuff today, and we keep these webinars to 30 minutes. We feel like an hour webinar is a little bit too long. Usually, people's attention starts going away after that 30-minute mark. And we really want to make sure that we hit on the highlights here today and outline what's really important and give you the guidance that you need. So let me launch into it and provide you with an outline. So Fannie Mae and Freddie Mac recently announced new condominium and cooperative lending guidelines. They released these guidelines on July 5th, 2023. And these new guidelines were created essentially to ensure the safety and habitability of condo and co-op properties for unit owners. Originally, Fannie Mae and Freddie Mac changed their lending guidelines in 2022 and came out with temporary lending guidelines as a result of the tragic condominium collapse in Surfside, Florida. And what these new guidelines did that were released on July 5th is they essentially ratified those temporary guidelines, or many of those temporary guidelines, and made them permanent. There's a couple of changes between 2022 and 2023, and I want to go through those. But the entire focus here is really aging infrastructure. How many, condo and co-op properties do we see out there with, HVAC units that are on the fritz, or structural issues, or mechanical components that aren't, up to par or haven't been maintained appropriately? The answer is, hundreds and thousands of these developments out there across the country aren't really mechanically and structurally sound. And we're seeing that as a result of our reviews of these condominium cooperative properties for lending approval. And also when we're doing peer reviews of other reserve study reports and other reserve studies in the industry. So Strategic Inspections is set up to do a super high quality reserve study for condominium cooperative properties that utilizes a lot of technology. Essentially, our reports are available online. You can have a board member view those reports online. You could have access granted to different board members and remove board members, and provide access to those reports to industry stakeholders. So it's important to understand that every reserve study is not created equally, and the reserve study that's provided here is really, really, excessive when it comes to compliance. That being said, let's delve into these new lending guidelines. So again, there's a major focus on aging infrastructure. The agencies are right. There are so many developments, and we see about 2,500 condominium and cooperative lending reviews a month at Condo Tech. And of those 2,500, we see around 70% of those properties that are clean and clear and have done a good job managing their repairs and maintenance of their components of the mechanical and structural components of those properties. And we see around 10% of those developments that we wouldn't lend $5 to, let alone, allow a purchaser or owner to get a mortgage on that specific property. And then there's about 20% of those units that end up being close to compliance with a little bit of work that needs to be done. And that's the trending rule across the industry. It's a 70-20-10 rule that holds up pretty well. We see, a lot of reviews and a lot of condominium developments and a lot of reserve study reports, and that tends to be the percentage numbers. So there's this massive focus on aging infrastructure, and Fannie Mae has an unavailable designation for condominium and cooperative properties, and that unavailable designation essentially outlines to lenders that residential mortgage financing cannot be provided on these properties as a result of some sort of mechanical, structural, or financial impairment on that specific property. And the agencies are finding out about this via condominium questionnaires and meeting minutes that are requested, engineering reports, violations, when they do violation searches on these properties. And it's causing a major issue in the industry. There are now over 2,000 properties, condominium and cooperative properties across the country that are on Fannie Mae's unavailable list or have an unavailable designation. And that's really important to understand, because last year there were only about 800 or 900 on this list. So the amount of properties that are being added to this list, it's a surging addition, essentially, right? We're seeing, in my market in New York City, there were around 50 properties added within the last year. And these are major condominium and cooperative developments that can't get residential mortgage financing through Fannie Mae or Freddie Mac. There is now, within these new guidelines, a required structural and mechanical condition assessment that has to be completed. Essentially, lenders have to ask questions about the structural and mechanical components of a condo or co-op property. The answers often don't want, property management groups have been advised by attorneys not to answer some of these questions. Boards have been advised not to answer some of these questions. And the agencies and lenders are essentially relying on the reporting that goes on in the industry, whether that's from reserve studies and or engineering studies or local municipalities that are doing inspections of these properties to make a decision on lending. Every single condominium and cooperative loan, regardless of whether that loan is conforming loan amount or jumbo loan amount that's provided in luxury condominium developments, goes through a process now of review of the structural and mechanical components of the property. The issues that are coming up with these guidelines is that, one of the major review points is also special assessments. And special assessments, a special assessment was for decades the vehicle by which condominium and cooperative boards would pay for, residential and, repairs to the common area components in a building. If you had a roof that was failing, a condominium or cooperative board would create a special assessment. And the problem with special assessments right now, there's been a shift in how they're viewed. And Fannie Mae and Freddie Mac both view them the same way. And that is to say that if there is a special assessment on a condominium or cooperative property, the agencies require that lenders delve into what that special assessment is for, how much the payment is for to each and every homeowner, and how much they're going to pay every single month. If that special assessment is for a major capital component that's going to impact the health and safety of the development, then that, critical repair is required to be completed before mortgage financing is available. And we have seen many properties get added to Fannie Mae's unavailable list because those critical repairs to major mechanical components or structural components haven't been completed. And essentially the flag was raised because of the special assessment that was created on the site. So special assessments are really frowned upon in the industry right now. And the only caveat to that point is you could have as many special assessments as you want, as long as you have enough capital sitting in your reserve account to pay for any of the repairs that you're collecting for within the special assessment. So a good example of that is, let's say the repairs you're doing are to a roof or replacing a roof, and the cost of that roof repair is $800,000, and you file a special assessment for $800,000. If that's a normal repair, not a critical repair, meaning that if they're just replacing a certain section of the roof and it's going to happen relatively quickly, you could typically have the agencies approve a repair like that if it's a normal and typical repair, as long as you have the supplemental documentation like reserve study saying that it is. And that special assessment will be accepted if you have the amount of capital sitting in your reserve account that's necessary to pay for that repair. So if you have an $800,000 repair and you have at least $800,000 sitting in a reserve account and you file a special assessment to essentially replenish that reserve account, that's acceptable. But that doesn't happen very often. What often happens is we have these large, multi-million-dollar repairs in some of the developments we see, and the boards don't have, the condo and co-op boards don't have that amount of capital sitting in their account, and they're not just replenishing their account, they're actually taking money and from the homeowners to pay for these repairs entirely. And that's an issue, and that will land you on the unavailable list. So any critical repairs have to be completed, and the focus is almost entirely on this aging infrastructure and the financial health of a condominium and cooperative development. And that's what these new guidelines have outlined. There's also some insurance compliance requirements that have come out recently, and this has become problematic because in some states, insurance is, HOA insurance is very hard to get. And in some cases, it's almost completely unavailable, like Florida, or very rarely available, I should say. And the cost for insurance for condominium and cooperative developments has surged. I mean, you're talking about in some areas a 200 or 300% increase in cost year over year for insurance policies. So what we're finding is that a lot of developments are essentially shorting their insurance requirements, making them non-compliant with Fannie Mae and Freddie Mac lending policies, and buildings are being added to this unavailable list as a result of that. When an insurance policy or a lesser insurance policy is obtained and costs go up within some of these developments, maintenance fees goes up. When maintenance fees go up, we're seeing that the first place where an association takes money from is a reserve account. And that also plunges them into these this unavailable designation for the property. Now, the point I want to make is this is not just for conforming loan amounts. These issues are also for luxury condo and co-op lending. So to understand this, you have to understand there are essentially two buckets, right? Conforming loan amounts, and Fannie Mae has, like in my state, in New York, or city, I should say, the maximum loan amount is about $1,080,000 for a condominium and cooperative loans or single family residential loans. And any loan that's done in excess of that amount, so if you get a mortgage for $1.5 million, let's say, on a residential unit, that's done through portfolio and jumbo lending. So what we found over the last couple of months is that a lot of the secondary market lenders and a lot of the banks that provide portfolio mortgage financing and jumbo mortgage financing have aligned with these Fannie Mae Freddie Mac policies. And in fact, if your building is on Fannie Mae's unavailable list, there's a reciprocal denial for these developments. So if you're not, on Fannie Mae's unavailable list and you're a luxury condo building and you typically go to Chase or Wells or Citi or, whatever large bank out there to get jumbo or portfolio mortgage financing, they have access to this unavailable list and they will review it. In most instances, will not provide mortgage financing to a building on this unavailable list. In very rare instances, do they provide mortgage financing to very well qualified borrowers or borrowers who have a lot of capital sitting at their bank. But it's not typical right now, and they're aligning with this reciprocal denial. So what we're also seeing here is that reserve studies are almost always asked for now. And this is a relatively new phenomenon because in the past, dependent upon which state you lived in and which state your building was in, we were seeing that you have, reserve studies that, weren't really required for review, but a reserve study is now utilized for almost every single mechanical and structural component analysis, right? So when we do a reserve study and strategic inspections, we send one of our professional engineers to the site to do an inspection, and that's an important designation as well. There are lots of reserve study companies out there that don't utilize professional engineers for inspections. And we think that the trend is going to be that that's going to change dramatically, primarily because these components have to be outlined as, in good condition in order for residential mortgage financing to be available. So it's important to know that these guidelines are impacting both conforming loans and luxury condo and co-op lending in their jumbo loans or portfolio, conforming loans or portfolio and jumbo lending. So what are the requirements for the condition evaluation, right? So when lenders look at a property and when a loan comes in, a loan is originated at a bank, they're looking for a reserve study that's less than 36 months old, an engineering report that's less than 36 months old that outlines, the condition of the structure, a violation search on the property to determine if, there's any municipal violations or violations regarding some sort of, component breakdown on the property. They're doing a litigation review to see if there's any litigation on the property that can result in, that is as a result of a mechanical or structural issue. They're asking for meeting minutes to see if it was, any of the condition issues were talked about within condominium property developments. Obviously, a condominium questionnaire with all of these new questions on it. Any special assessment terms. So if the building has a special assessment, they want to see that special assessment. Owner delinquency information. Are the owners making payments on these special assessments or are they delinquent on them? And any data on capital loans. And we're going to delve into capital loans pretty deeply here in a second, because I think it's probably one of the most important new aspects of condominium and cooperative lending. It's actually accepted across the board by Fannie Mae and Freddie Mac instead of a special assessment. And I'm going to delve into that in a second. So what we've done here within our organization is created a reserve study report that essentially outlines every single aspect of this review. We provide a mechanical condition assessment, a structural condition assessment. We report capital balances in operating accounts and reserve accounts. We evaluate special assessments. So we actually look into the special assessment, outline how long it's for, how much it's for, what the reason for the special assessment is the repair completed or not. We list out all the property violations and if they are, for mechanical or structural condition, and then comment on that within our report. And we provide a complete component condition summary on whether that's on the amenity space or the common area components within the building, the shared components within, commercial and residential structures that we see out there. But it was this report, we developed it in order to provide lenders and property managers and boards really with a clear outline of condition. And so when a lender reviews a condominium development, they have to go to one place within a report and get all the information they need about a specific property. We also outline within our lender property analysis a complete analysis and outline of any capital loans that the building may have. And I promise you to return to that. So I'm going to show you what the lender property analysis looks like. And I know there's a couple of questions that have come up and some hands that are raised, and I'm happy to give you some answers to these questions, to the questions before the end of this presentation. But let's just delve into capital loans for a second, because they're part of the solution for these new issues regarding, deferred maintenance. Deferred capital expenses and critical repairs that have been completed, and this aging infrastructure issue, I should say, across the industry. And the review of the aging infrastructure of condo and cooperative developments. So capital loans were for a very long time provided to condominium cooperative developments in different ways, right? So condo developments typically are able to get something called a CIRA loan. And that loan essentially is provided based upon a calculation of the maintenance fees on the development, and a lender will come in and provide a capital loan to the association, to a condo association, to the HOA, and it's based upon the amount of maintenance costs per month. And they have some sort of calculation that allows them to outline how much they'll lend. And some of these CIRA loans are, they used to be for $200,000-$300,000, and now we're seeing them for large amounts, $3, $4, $5 million, sometimes even more. And then for cooperative development, there's a couple of other options out there, which is, an underlying mortgage or a line of credit that they can get. It's almost easier to lend to a cooperative development as opposed to a condo. But there are loans available for both types of associations. And the reason that's important to outline is that the agencies view a capital loan completely differently than a special assessment. Essentially, capital loans are primarily accepted. And the way it's kind of looked at is that the association has done their due diligence, knows what repairs have to be made, and has planned for the future capital needs of the development, in addition to their reserve account or holding money in their reserve account. So this is a really important designation that was made, because in the past, I don't want to say capital loans were frowned upon, but they certainly weren't, provided with the same acceptance that they currently are in the industry. And I'm guessing, but I think that the industry has kind of looked, or the agencies have kind of looked at this and said, a capital loan may be the only vehicle where a condo or co-op development could remain in the good graces of lending, essentially by planning out their future repairs, and still essentially, not, borrow the capital in order to make these repairs. So long story short here, in order to provide a capital loan, you need to know what money you're going to need to spend. And within our lender property analysis, there's an entire section on, capital lending that we typically add in. We essentially provide a capital analysis summary in that report. But what's important about these reports is they outline repairs that need to be made year over year. So, how much money is going to be spent in 2023, 24, 25, and what components are going to be repaired and replaced. It also gives a complete condition assessment on the structure, on the building exterior, on mechanical systems in the building, on the building interior, And that condition summary is typically one of the ways that you can get residential financing approval, and in some instances get off of Fannie Mae's unavailable list if you are put on that list. So what we've found is that, this report, and we've run it through some of the agencies, and we've run through, the way we've put it together, is going to be one of the solutions for properties that are on the unavailable list to prove that these properties have now been inspected and that there's no structural or mechanical issues within them. It also speeds up the process of underwriting a mortgage within these properties because all the information is right here. And in addition to that, it provides a capital lender, a lender who will provide an HOA with a loan, a really good analysis of how much money they're going to need and what the cost is going to be to that specific development and how it should be viewed when underwriting that development for lending approval. And then finally, what are these solutions that we've kind of recommend here? And again, we run through these webinars at 30-minute intervals, and they might be a little bit speedy and we might provide a lot of information very quickly, but we think it's more important that you have a quick hit and actually know what the issues are. So reserve studies and engineering reports that are less than 36 months old are a solution for lending compliance, and in many instances are going to be required in many developments in order to prove mechanical and structural stability. Mechanical structural analysis within those reserve studies, which typically can only be performed and be commented on by a professional engineer. And that's why we utilize professional engineers for our studies. You need a complete outline of component repair planning, right? You need to plan out as an association, not only what repairs are going to be performed, but where that capital is going to come from in order to make those repairs. You want to avoid special assessments, and you need really a complete project-wide lending analysis. That's important right now because in many states across the country, we're running into carbon emissions reductions requirements and the costs that are associated with those carbon emissions reduction requirements. Again, in my state, New York, or city in New York, we have local law 97, which is going to cause a lot of developments essentially to repair or replace a lot of their interior components, mechanical components within the building in order to reduce their emissions. And the cost of that is in some cases going to be quite expensive. So you really need a not only a project-wide financial analysis, but a project-wide lending analysis to see if this property actually can get mortgage financing going forward. And then applying for capital loans early, identifying what these issues are. And we'd argue that right now, almost every single development we see should apply for a capital loan. Whether or not they take it is another story, but when you do a reserve study, you're going to get an outline of what future costs are. And I could guarantee you that the capital loan solution is probably one of the best solutions we've seen to not only remain compliant, but to have a clear financial path forward of what it's going to cost homeowners in the future in maintenance costs and the repayment costs for these capital loans. And then you have to complete component repairs. You cannot leave repairs stagnant, non-completed for, we've seen in some instances 2 or 3 years. Those repairs have to be completed to major capital components. So that being said, and I'm going to answer a couple of questions. We did provide you with the links to Fannie Mae's lending guidelines, Freddie Mac's lending guidelines, a strategic reserve study order link if you wanted to make an order or place an order, or just get a quote. There's my information, Mercedes, who's our customer service rep, and Chris Bevis, who is our director of reserve study projects. Those are our 3 key employees in the company, and their teams handle most of the reserve studies, not only in New York City, but across the country. So let me answer a couple of questions that came up. Yeah, I think somebody asked, is it more like a business line or a line of credit, or would the money be there in the account? So to answer this question, and thanks, John, for the question, you could get a line of credit, and it's just as acceptable as a capital loan that sits in your bank account, or an underlying mortgage. So a line of credit works just as well. If a condo gets a capital loan, it's usually repaid by the special assessment. Have the lenders reconcile this? It's a great question. The answer is it's accepted as a special assessment repayment vehicle. So if you get a capital loan, essentially it outlines that you've planned for the future and planned for these repairs. Even if it is paid back within a special assessment, it is accepted by lenders and lending agencies. So again, the key here is if you get a capital loan, it provides not only the solution of getting the financing, but in many instances, lending approval. So if there are no questions, this presentation is going to be available on our website. Oh, I think we got one more question. Yeah. Roberta, please type your questions into the Q&A. Happy to answer them. Happy to answer it. In the meantime, well, I guess that question is being asked. This presentation is going to be available. Melinda's going to send it out to everybody who was on this presentation. Please share it at your leisure. One final parting note is that, property management firms out there that we've dealt with, there are some very, very good organizations that have solutions, and there are some organizations that we've witnessed, property manager apathy towards this issue. And the apathy that we've seen out there is devastating for some of the condominium associations we work with. Not just today, but 2 years from now, 3 years from now, when no lending is available on the site, and it's a property that suffers from major deferred maintenance, and unit values typically plummet. So the firms that we do work with that are really good at this really have solutions across the board, right? Solutions not only for getting the data that's necessary within these reserve study reports or engineering reports, but also providing solutions for capital management and capital loans and capital lending. And I would encourage all the property management firms that are on this presentation today, and I know there are a lot represented, to ask internally or to, find out a way to essentially set up capital lending, because it's that important right now to get loans to these condominium cooperative associations and have these conversations with your board members. Some folks do a really good job at it. We'd like to see a really good job done across the industry. So last question here. If the condo loan provides for owners to either pay their portion over time or all at once, is it related to the same? Have owner-occupied guidelines been changed? Okay, so whether or not an association pays, I'm guessing for a special assessment up front as a one-time fee, that's acceptable, and that will get you off Fannie Mae's unavailable list pretty quickly, because you're going to show the capital that's in the account, or the capital that's been collected. But we typically don't see that. We don't see a one-time payment being made for a special assessment. Loan payments are accepted by the agencies, and I think that's your question. And the owner occupancy guidelines have not been changed. The owner occupancy guidelines are still the same. And I lied, there's one more question. Do most management companies know about this? Or as I bring it up to those with whom I have listings, are most unaware. Look, across the industry, we've seen both. We've seen property management companies that know these things, that are very well educated and proactive, whether they're doing energy reports in order to determine future costs, or offering their their constituents, their condo and co-op boards loans, and contacting them for capital loans, and outlining the need for them and getting them reserve studies. We're seeing some property management companies that are really doing a great job. There are others who for lack of a better word, phone it in sometimes. And don't provide the guidance which we wish they would provide, because we spend a lot of time educating the industry. So I don't know, maybe it's a 70-30 split, with 70% of the management companies not providing the guidance as they should. So hopefully that changes a little bit with these new lending guidelines. Anyway, going forward, I'm going to leave that as the last question. Going forward, if you have any additional questions, please contact me. I'm happy to provide you with the answers. I'm happy to provide you with the reserve study report. And please ask for our new lender property analysis on all reports that you are doing with us. It's really a spectacular way to clear the runway for lending within any condo or co-op property. Thanks all. Take care.